this is the annual meeting for Peterson Capital Management. Welcome. I'm Danielle Town, and I'm going to be moderating the meeting. I'm going to be asking your questions that you put into the chat, like Matt just mentioned. And that way, Matthew can focus on answering them without having to be reading and scrolling through the chat, which is almost impossible to do all at the same time. So I've interviewed Matthew on my investing podcast and my newsletter, and through various value investing world events and community, we've become friends as well. So it's been such a pleasure to watch his fund's incredible success. And I was honored when he asked me to come and moderate the meeting. I, of course, would have stayed up to be part of it anyway. I'm in Zurich, Switzerland, where it's almost midnight here. But it's really fun to be part of it. So thank you for asking me, Matthew, to be part of it. So I'm going to go quickly, as he said, through a brief overview of the process and then introduce Matthew, and then we'll get to the substance of the meeting. So as he said, everybody has been muted. We figured out a way to actually make that happen. And so I think you're not actually even able to unmute yourself. You can, however, put your video on or off. That's up to you. Either way is fine. For your screen layout, if you just put your mouse over the main Zoom screen, and you may want to do this differently as Matthew goes through his presentation, you can switch by using the button that says either gallery view or speaker view, and you can just toggle between those two modes and see which one works better for you. So he's going to give a presentation first, and then he'll take questions. So how do you ask questions? Do so by writing it straight in the chat window. And if you don't see a chat window right now, put your mouse over the Zoom screen, look at the bottom menu there, and right in the middle, there's a big word that says chat. Click on that, and the chat window should open up. And then you'll be able to write questions right where Brad just said, questions go here. Thank you, Brad. And you can write them either, you'll see right below that area, there's a little blue button, and you can, it'll say everyone. And if you write the message and it says everyone, it's going to be able to be seen by everybody. If you want to ask a question, maybe you want to ask it anonymously, that's completely fine. You can just send the question straight to me, Danielle, just choose Danielle Town on that chat, and the question will come privately to me, and then only I will be able to see it. Okay, so technical stuff. Should we experience, hopefully this won't happen, but should we experience any major technical issue if the meeting closes all of a sudden somehow, just go back to the link that you used to show up here and click that link again, and we'll all come back to the same meeting room. So just use the same link you already used. And let's get to the meeting. So I'm just going to quickly introduce Matthew. Matthew Peterson is the managing partner of Peterson Capital Management, which he founded in 2011. He's been a financial professional for 2 decades, is a chartered financial analyst, and has worked with Goldman Sachs, Morgan Stanley, Merrill Lynch, American Express, and Ameriprise Financial. And with that, Matthew, I'll turn it over to you.
Wonderful. Thank you so much, Danielle. Thank you for being here. And thank you, everybody, for being here. This is obviously a very interesting and new format to be hosting this meeting. So as Danielle stated, I am going to share my screen and put up a few slides so we can move through things here. So I'm going to cover a few of these slides, and then, as she mentioned, I'll open up for Q&A. And with that, I hope that we can dive into some of the most important things that are on your mind. So the agenda today will begin with some volatility-based alpha. We'll move into our value process and framework, and then discuss some of our wealth-building compounders. But first, we need to have a quick word from legal. So during these uncertain times, we are once again in an extraordinary environment to execute our core value investing principles and combine them with the structured value approach that we have been employing since inception. So some of you will recall how we use this very unique and advanced approach, but I'm sure many of you won't realize the potential in this environment. So we buy our securities through an entirely different manner than any sort of retail investor would. And this is best explained with an example. So we do things very differently. If you look at this slide here, let's consider an equity that was maybe trading for $200 per share and has fallen to $100 per share. Something that we might want to own, and through deep understanding of the business and valuation, we believe its actual true value to be perhaps $125 a share. So what are our options? You know, you can go into the New York Stock Exchange and buy this security through a market or limit order, but that's actually not what we do, particularly in extreme volatility as we're seeing right now. Volatility is one of the factors that feed into the Black-Scholes model, and that's what's used to price things like these contracts that we use. These are basically put contracts that I'm going to describe, and it's the primary way that we enter into these securities. So what happens is, instead of going to the New York Stock Exchange to buy the security, instead we head to the Chicago Board of Exchange, where we can engage with an individual counterpart and literally make a contractual agreement with them, sell them a cash secured put contract, guaranteeing that we will purchase their shares for $100 over a period of time. So instead of buying it for $100 in the New York Stock Exchange, we just commit to buying it for $100 through the Chicago Board of Exchange. And we are paid for that commitment. And when volatility is extremely high, the IRR, the level that we're paid, the premium, grows significantly. And so in a environment that like we're in today, it's quite easy to pick up, say, $25 for this commitment to purchase a stock for $100 that we think is worth $125. And we pick up a $25 premium, and then we basically hang on to that along with our $75 in collateral. And then we wait. We wait for over the course of the year, and if the shares go below our 100, our counterpart has the right to sell us their stock, and we actually love it when they do. We've now gained ownership of those securities for $75 a share. So we bought them at a discount to what they're selling for at the New York Stock Exchange, a discount to what any retail investor would pay for these shares. And alternatively, should the shares appreciate in value, the contract ends after a year. They've paid us the premium. We keep holding that premium, and we've now earned a 33% return on our $75 in collateral over a year. So we've earned 33% just on the premium due to this increase in volatility. And everyone, we are in a zero interest rate environment. So the fact that we have this opportunity at the moment is just incredible. And most importantly, volatility is back. During Q1, markets experienced the fifth decline in excess of 30% going back 40 years. Peak to trough, the S&P 500 fell 34%. The Dow fell 37%, which was the fastest rate on record. And the VIX, which is the fear index, exploded from lows of low teens. In fact, for several years, it was sub 10, and it exploded to 85, which is also another record. It's the highest. This is the fear index. We are at the highest ever amount of fear. And most of us rationally know to be greedy when others are fearful. So seems maybe obvious, but here's the secret. If you want to make money when fear is breaking all records, you need to ignore the noise and get hyper rational. It's important to do this right now because theory and practice actually are inconsistent quite often. And the inconsistencies between economic theory and reality become more obvious during times of volatility and uncertainty. So in theory, for example, we have the efficient market hypothesis. The efficient market hypothesis tells us that markets are efficient pricing mechanisms and everything is priced perfectly all the time. And it's amazing. Even the professors that teach this stuff know it's not true. It's pretty funny. So in practice, we know that markets are made up of people who are swinging to emotional extremes. So it's better to conceptualize a market not as a perfect pricing mechanism, but as a pendulum. This pendulum swinging around at different prices in the short term based on human herd psychology. So just think about it for a moment. Where are we today? We're in a global pandemic. There's social unrest. We have political uncertainty. We're in a recession. Fear is at a maximum. We have the VIX is volatile. We have 5 trillion sitting in cash in customer money market accounts at banks. This is an incredible record, earning 0%. The unemployment rate hit 20%. We have, people are worried, people are scared, people are really uncertain. In fact, we're in a period of greater uncertainty right now than most people alive have ever experienced. And the vast majority of stock market participants, they sort of talk about markets, and one of the positive aspects being its liquidity, which means that underlying their investment thesis, they're focused on the short term, or they're at least aware that they have the ability to exit. They're certainly not long-term business owners like we are. And this is where long-term business owners can really thrive. So after we were up in 27% in 2019, our performance took a short-term hit as well. We were down 29% during the first half of 2020. But as I'm going to prove to you all, this is not of any concern for long-term investors. This is not a concern for me and should not be a concern for you. And you'll say, Matthew, how are you going to prove that volatility isn't a concern? Well, I'm going to clear that bar. So risk is the permanent loss. Risk is the probability of a permanent loss in capital. And we are incredibly risk averse. Volatility, however, is not synonymous with risk. And that's why on March 25th, at the bottom, I sent the first special memo in 9 years of our fund's history to every limited partner, urging them to invest. And so I quote from the memo that I sent out: amid the daily tragedies, this historical moment has to be one of the rarest and most unique opportunities to buy equities in our lifetime. With volatility peaks combined with new deep value opportunities, this is by far the most exceptional moment to invest we have experienced since the inception of this fund in 2011, 2012, and 2013, when returns were extraordinarily strong. I then continued. 2 situations alone create a 30 to 40% upside return in the near term and do not include many other promising aspects of our portfolio. We do not fear price volatility around high quality opportunities. Now, some of you jumped at that opportunity and your rationality will be rewarded. And more of you are joining now and you too will be rewarded. And for the rest of you, you have to ask yourself, what are you waiting for? This is literally hell freezing over. This is the plague. You have to be greedy when others are fearful. But nobody said it would be easy. It's actually very difficult. And that's the point. So I mentioned that in H1, our portfolio prices dropped 29%. All of our very valuable holdings went on sale. And my hope, before I show you the next slide, is that you recognize we're at the very beginning, because of this environment, we're at the very beginning of a long runway packed with extraordinary opportunities for the fund. And so thus far during the second half of 2020, we are up over 33%. And so that's in the last 7 weeks. So exactly as I explained in the memo. But the world has changed. So we're now getting paid 30, 40, 50% IRRs in premiums for commitments to buy deeply undervalued companies from counterparties on the Chicago Board of Exchange who are very fearful and maybe don't have a grasp of the qualitative aspect of the business. So we now have the wind at our backs. And our focus is on managing this downside risk. We own superior, high quality, valuable businesses. And we're certainly concentrated. So we experience short-term price movements. But if the businesses we own are growing, if the value is growing, the prices in the market will ultimately catch up to that value. So again, we're in a new environment. The volatility and uncertainty is extreme. But if you focus on bottom-up business analysis like we do, this is the environment where we're all going to thrive. So these businesses, we're looking at businesses that go out far beyond this uncertainty. We're looking through this uncertainty. And those of you that do the same will certainly be rewarded. So a process is essential for this success. And I've actually written on this extensively in annual reports of the past. We have a very specific and unique process. So with each of these steps is an alpha enhancing step over the long term. So we use very specific channels in step 1, including 13F analysis and reports to identify a pool of potentially deep value opportunities. So like Charlie Munger says, you have to fish where the fish are. So we're narrowing down the global set of securities, let's say 10,000 potential investment opportunities to maybe 100 that we can reasonably look at. And what we're really doing is we're finding needles in a haystack, and we're sort of sorting through needles among needles. And the second step here is that we employ, of course, fundamental analysis to identify the deepest value, along with things like the top management and the very best business models to get us through that step. And then step 3 in the process, of course, as we discussed at the very beginning, is our unique approach to gaining exposure to these businesses where we're paid a premium and then use the short put as a tool to purchase our equity. And very much today that allows us to get in far below market prices or pick up very high IRRs on the premium. And then finally, we need to focus on portfolio construction. And we apply methods like the Kelly criterion, which optimizes the portfolio construction. It allows us to be, or it recommends and suggests that we are much more concentrated. And so we do ultimately have a very, we optimize the portfolio, and we definitely don't over diversify as many of you here on this call who've heard me speak about this will find in most other mutual funds, index funds, and all sorts of other opportunities. So we are definitely optimally diversified, which means that we will have some volatility. There's also another framework that I think is important to share with you, and this is our co-priorities framework. So when we're looking for a portfolio position that's going to compound at high rates of return, we're looking for a very rare gem. I mean, these co-priorities are very hard to find. So we're looking first for an exceptional business model, and then superior management, and then of course, extraordinary value. And when you get an exceptional business model and superior management, typically it's very hard to find it at a good price. But this framework is essential because an exceptional business model will draw significant cash flow into the hands of management. So you better have really high quality management, because one of the primary responsibilities of the managers, with the CEO, the C-suite of these companies, is allocation of this business cash flow. So they actually need to be exceptional capital allocators. When the C-suite has cash, they have options. They get to make decisions. They can reinvest in their own business, or they could pay off debt, or they could issue a dividend. They could engage in some merger or acquisition, or they could start buying back stock. There are really 5 major buckets they have. And they need to make these decisions from the perspective of a long-term shareholder. Because when those decisions are made well, the compounding then can continue and even accelerate and become a very nice system. So finally, the third co-priority, we are value investors. So we're not going to overpay even for great businesses and great managers. We're actually looking to pay far less than the intrinsic value of the underlying business. And our portfolio is comprised of these rare opportunities. So as you know, we have, of course, we manage an extremely concentrated portfolio. In fact, these 4 holdings, Daily Journal, Berkshire Hathaway, Dondo, and Thales, make up over 50% of our portfolio. So we are not immune to short-term price swings. Daily Journal, in fact, has gone from 300 to under 200 and back to 290 in 6 months. And as I'll show you, it's worth over 1,000. So I was never worried. It never gave me one moment of concern. We are also focused on very asymmetric risk-reward situations, firms that have embedded downside protection with the potential of just parabolic upside. And so we want, great firms run by great people selling for a cheap price with asymmetric upside. And believe me, there's not a lot of those out there. So why is there so much value in these firms here? Well, because for one, a lot of the value is hidden. So you won't find these stocks showing up in your stock screener. There's off financial statement value here, and they are misunderstood by the market. So I will provide details on, I'm going to provide some details on Daily Journal and Berkshire Hathaway briefly, with the caveat that we typically do avoid the discussion of current holdings due to the well-known commitment and consistency biases. But in reality, these are long-term Fisher compound. These are long-term Fisher compounders. We're going to hold these for a decade or longer. I actually don't mind sharing them, but I am aware of the biases that it creates. So as we hold these for this decade plus, we will of course continue adding to these positions or selling puts and earning premiums during the dips along the way. So Daily Journal Company. This is basically a big secret. So most people have never heard of this amazing firm, and anybody outside this room who has will mostly tell you that Daily Journal is a newspaper business. It's not a newspaper business at all. It was a 10 newspaper business that now contributes less than 25% of the revenue. And what's happening today is totally misunderstood. I actually presented a few of these slides in Switzerland last year and titled my talk Hiding in Plain Sight, because this is such an obvious example of a terrific business model, exceptional managers, and deep value that is not apparent by looking at the financial statements. So who runs Daily Journal Company? Who is the management? Daily Journal is managed by many of the best business managers in the history of the world. Charlie Munger, Buffett's partner of 55 years, is the chairman. He bought the company 43 years ago with for $2 million with Rick Guerin, who's on the board as well, and was written up in 1984 by Warren Buffett as being one of the 6 super investors of Graham and Doddsville, but he basically was saying super investor of the world. Peter Kaufman's on the board. Peter Kaufman is incredibly wise and known for writing Poor Charlie's Almanac. He's the CEO of Glenair, which is also a very successful aerospace manufacturing firm. And many of you are probably familiar with his work. Regardless, the point is, the company is completely stacked with hand-selected talent by Charlie Munger over 4 decades. So we've got the management covered in spades. What's the business? Well, this company has one of the, naturally, because of management, has one of the top business models in the modern economy. It's a SaaS business model. It's software as a service. They have a family of software products that are provided to courts and municipalities around the nation and around the world. And these products help courthouses manage cases and information electronically. They interface with other critical justice partners, and they extend electronic services to the public. So they can pursue things like electronic filings, or there's a website where they can pay traffic citations and other fees. So when it comes down to now the third bucket for co-priorities is the valuation bucket, that's all we really have to understand. They have the best managers and they have the best business model. So what is the valuation? And this requires a bit of background. So Rick and Charlie, Rick Gurn and Charlie Munger bought a newspaper called Daily Journal 43 years ago, and it was $2 million. And over the decades, they accumulated 10 newspapers, which is why people mistakenly assume it's a newspaper business. During the financial crisis, it's important to know that they had about $50 million in cash. And so Gurn and Munger, in March of 2009, bottom ticked it to the day and put all their money in at market lows. They bought, I think, 75% of the portfolio, as well as Fargo and Bank of America. They also clearly believe in concentration. And they've turned it into a $150 million equity portfolio today. And by the way, that equity portfolio is down from $200 million at the beginning of the year, but I guarantee you that that's absolutely no concern to them at all. So $150 million in an equity portfolio. And so much of this is, so this is a $400 million market cap company. And, you know, much of this, let's put the newspapers at a value of 0. And it's really not at 0 at all, but we can just ignore them and have a secret asset inside. So they basically have a $150 million equity portfolio. They have $16 million in real estate because they own a few offices, and then they have $10 million in cash. And then if you count for the $60 million in long-term debt, which is actually the most amazing type of debt, it's deferred capital gains tax. They never have to pay it, and it's at an interest rate of 0. It's because they have their equity portfolio went up. So they've got deferred capital gains tax and then kind of a $30 million non-callable margin loan on the equity portfolio. So they borrowed $30 million to build out the technology piece. It's non-callable. They never have to pay it before they can pay it whenever they want. And the interest rate is 0.75%. So if you thought your mortgage was low, Munger's figured out a way to finance his business for 0.75%. So that leaves, so they've got the equity, real estate, cash minus debt. It leaves $115 million in solid assets that are actually liquid, net of debt. And then all you're left with is this technology business. So that has the perceived market price here of 285. It's 285 million. It's a tiny micro cap run by a group of the best investors of all time. So the question really is, what is the value of the technology and software firm? And so to understand this, I need to share with you a brief story. After 10 years of following the firm and some attempts to understand what was happening in the software space, I began to discover that the information was so sparse that none of the professional fund managers or Munger fanatics knew anything about what they were doing in the tech space. And so my search continued, and during this extensive search, I discovered that there was a customer training seminar that was taking place in Utah. So I thought I would try to attend the training, but without government credentials or a court ID, it was impossible for me to register. So ultimately, I flew to Utah during the training. I booked a room in the hotel and I sat in the lobby for 3 days and I interviewed the customers as they moved between all of their training sessions. And the information I uncovered was enormously valuable. I learned customers live and breathe in this software. When I say customers, I mean courthouse employees and the customers of Journal Technology. They live and breathe in this software all day. I learned how much more efficient it made their jobs. But most importantly, I learned that one of the main competitive advantages that Journal Technologies, which is the name of the subsidiary, had created was approaching the bureaucratic RFP process with a 4 to 7 year billing delay. So they're getting a major government contract and not billing them for 4 to 7 years. Imagine that. I mean, this is all of the ongoing costs are on their financial statements, but the revenue is being totally unaccounted for. So that was so shocking to me that I've never seen something like this. That means that tens and perhaps hundreds of millions in revenue are missing from the financial statement of a $285 million tech firm. And further, a lot of it's going to drop right to the bottom line, or at least be able to be reinvested in new high growth opportunities because management's excellent, which is why this is hiding in plain sight. So I brought in an intern to focus intensely on searching for these government contracts, because although this was absent from the Daily Journal financial statements, I realized it would probably be accounted for in cities and municipalities pursuing an RFP process or an implementation. So we searched across 3,000 counties in the US, scanning state and local government meeting minutes. It was an incredibly onerous process. We were searching for keywords like Daily Journal, Journal Technologies, all sorts of software, just for some clue that a court software solution was being implemented. And we found incredible things. We found contracts in Los Angeles. Los Angeles owes them $5 million. Austin, Texas owes them $1 million. And we found 2 software implementation contracts in Australia for $16 million and a whopping $89 million. All unaccounted for on the Daily Journal financial statements because of their deferred gratification ethos and approach. So in total, we ultimately identified over 100 implementations across America, Canada, and Australia. And many of these contracts are huge contracts. So I also learned, as we think about these valuation, how we're going to value this firm, I learned in the training conference that the software was sold in 100 license units for $100K a year, with an inflation-based price escalator and a 10-year commitment. This meant that the revenues were going to be incredibly sticky, and they had pricing power once the implementation was complete. And by the way, as you will all know, no bureaucratic municipality is going to switch software programs after 10 years of use and experience. So further, I developed I understood that demand was growing quickly. I learned that demand was going quickly because once these implementations were complete, what I learned from the customers is that demand for the licenses, the individual licenses, was growing because each employee benefits from ultimately having their own independent login. And again, I discovered that with all of the interfaces that they had created for the external justice partners, once the implementation was complete, many of these partners would then request their own implementations so that they could seamlessly interface with the courthouse electronically. So the whole ecosystem is pointing in this right direction. I mean, this is all happening right now. It's just incredible. Many of these municipalities and courthouses run really terrible, antiquated systems. And frankly, that's why you always see attorneys carrying around massive briefcases filled with paper. And here is a little known newspaper company run by the most brilliant men alive, providing a major efficiency to this enormous space. So ultimately, I don't know how large this is going to become, but they have incorporated all of these moats into this business and designed it to thrive. So what are some of these? I mean, they're operating in a huge space with network effects. They have pricing power. There's enormous switching costs. They've implemented invariant strategies like deferred gratification, trust. They have win-win relationships with the whole ecosystem, from the courthouses to the regulators, to their customers, to their shareholders. They have, the customer becomes completely dependent on their service. They operate a SaaS business with huge margins, but on top of that, the way that they present this to the courthouses, it actually delivers a great IRR for the buyer. It's a better product, and it also continues to improve with society's dependence on technology. So with all of that, I mean, good luck competing with that. With all of that, we've modeled out that high margin revenues are going to reach 150 million for the subsidiary this decade. And it will still be very early in their long-term potential. So with a reasonable multiple on high margin income, this is perhaps a $1 or $2 billion business tucked inside of a little microcap newspaper priced at $285, 285 million bucks. So, and then I will also add, there's the growing 150 million equity portfolio. So, you know, this, with all of this that we've discussed, you know, if the business basically evolves as it's evolving, the 200 and 300 price range of the stock is going to go over 1,000. We just literally have to be patient. So again, 300 to 200 to 300 in 6 months sounds scary. I know, doesn't it? But I can't emphasize enough that this volatility is absolutely no concern. We have firms that, you know, the firm should be selling for 1,000 or more this decade. And in fact, I don't want to start speculating too much, but they could start offering all sorts of additional software. I see new businesses popping up in the contracts, like cloud hosting services, all the time. And should they start wanting to manage public school technology or adoption agencies or handling sensitive government data, the prospects just jump further. So they have a long runway ahead. They're in a huge open space. And if the business reaches 3 billion market cap, we'll end up with 10x on our investment. So finally, regarding Daily Journal, thanks for all your patience with Daily Journal. I promise not to do this with Berkshire. Let's talk about the asymmetric risk reward. So if you wanted to argue that the technology business would completely fail, it's worth zero. That's hardly a possibility. The equity portfolio that they have, the 150 million equity portfolio, is going to grow into the market cap of the entire firm this decade. So despite the volatility, the risk of loss over a few years is close to zero, while the upside is conservatively many multiples of the current price. And the risk reward is completely asymmetric. And so I wanted to go through this in detail here because it hopefully helps explain why I'm completely comfortable with firms like Daily Journal as large, volatile, long-term holdings in the portfolio. And it actually makes dips in the price, exciting opportunities, not scary ones. So let's examine Berkshire Hathaway. And I'll be brief here. Berkshire is another core holding that hardly requires that type of introduction. They have extraordinary management. Many of you will be very familiar. They have an exceptional diversified businesses. And then these businesses have been hand-selected by Warren Buffett and Charlie Munger over many years. The business model primarily is based on float or a negative cost of capital. And then finally, they are very cheap and they have significant downside protection. So last year at this meeting that some of you attended, I showed their pathway to 1.7 trillion valuation. I wrote about it extensively in our annual letter as well. But I'm going to simplify this even further. A breakdown of Berkshire can be viewed as follows. The market cap is 500 billion today. They hold 145 billion in cash. They have a 210 billion equity portfolio, and nearly half of that, by the way, is Apple. They also have 100 subsidiaries like BNSF Railroad, NetJets, and Geico. And if you put a really reasonable multiple in this environment on these operating companies earning 22 billion per year, put a multiple of 15, you get a 330 billion valuation. So that gives us the value today of 685 billion and growing. So that's a full 35% upside to today's price, just to reach a conservative fair value. And that doesn't include things like stock buybacks that are now approaching 10, I mean, they're basically looks like they're gonna approach or pass 10 billion this year. So this is a firm, again, that thrives during uncertain times. And Berkshire has $145 billion in cash sitting ready to be put to work, which will clearly enhance that value further. So, but you'll all recall from the very beginning, the secret we have on volatility is that we use puts to enter these positions, right? We're selling counterparts puts, the Chicago Board Exchange. People are paying us to buy their undervalued Berkshire. And in this environment where in previous few years, we might pick up a 5% IRR, we're now getting enormous premiums on Berkshire Hathaway. So during dips in Q1, with a current value of 280 per share, which you saw on the last slide, we were able to commit to buying the shares from a counterpart for $165 over a 6-month period. We would be delighted to buy Berkshire for $165. And those contracts expire in September. It's coming up next month. And we were paid $18 for our commitment to buy their stock for $165. That reduces our price further down to $145. But we're not going to buy the shares. Actually, what they handed us was a 25% IRR on an extraordinarily safe opportunity in a zero interest rate environment. I mean, I can't emphasize this enough. It's just so remarkable that you take a company as secure, maybe the most secure business available, and when it's dipping in price, people are paying us a premium to buy their shares for a price below the current market price, and we're earning 25% annualized premiums from what people are paying us. It's incredibly safe, and it's remarkable. So these types of situations are why it's such an extraordinary time to be putting capital to work right now. And so I would like to remind everyone of our mission statement. Our mission is to provide a world-class capital allocation vehicle that builds enormous wealth for our long-term partners. And finally, a very important thank you to our exceptional service providers. They work tirelessly to keep all the operations running smoothly. And so with that, I hope we have a few questions. I'll turn it back over to Danielle, who can moderate the Q&A.
Thank you. Okay, so the first question here is, would you like to suggest at all that people consider